Hi, welcome to Incomplete Records. Incomplete records signify accounting records that do not satisfy the double entry system of accounting, or rather, accounting records that fall short of the double entry system of accounting. The system whereby for each transaction where there has to be a debit entry and a corresponding credit entry is not maintained or is not found under the incomplete records of accounting. So you find that in some cases there may be loss of records, maybe in the event of a fire, in the event of theft, or in the event of negligence on the part of the trader or the business person, you find that there are no records at all. As such, you end up with incomplete records. In some other cases, you may find that the trader is recording his transactions, but not on the double entry system of accounting, but on the single entry system of accounting. Under the single entry system of accounting, you find that the trader only records once in the books of accounts. So you find that in most cases they have a cash record, whereby they record cash inflows and cash outflows. So say for instance, when they pay some expense, say for purchases, instead of them debiting purchases account and crediting cash account, they only credit in the cash summary. So they do not put any entry on the purchases account. So under single entry system, you find that the transaction is entered only once in the books of accounts, which is instead of the requirement of double entry, whereby for each transaction that the recording has to be done twice in the books of accounts. So under such, you also end up with incomplete records. So you find incomplete records whereby that in some cases it may be found that there are no records at all, either owing to neglect on the part of the trader or loss of records by theft, fire, or other causes. So you find that some records have been lost. As such, you end up with incomplete records. And in some other cases, you find that there may be records. Yes, there may be records of transactions, but not on the double entry system of accounting. So such records are said to be on single entry system, whereby the rules of debiting and crediting are not followed, whereby for each transaction, instead of recording twice, whereby there has to be a debit entry and a credit entry, you find that the transaction has only been entered twice. And in most cases, you find that these transactions are only entered in the cash book or in the cash summary, or rather, the trader keeps only the cash record of transactions. So he only records receipts and payments of cash, the inflows and outflows of cash, but does not record any other. And as I've given an example, say in the event of purchases, as you understand under the rules of double entry, for cash purchases, you are supposed to debit purchases, credit cash. That's under the double entry system. But under the single entry system, you find the trader, instead of debiting purchases and crediting cash, he only records the outflow of cash. There is no record on purchases account. So as such, accounting records need to be recorded on the double entry system of accounting. And if you encounter a situation whereby the single entry system of accounting has been applied, you need to reconstruct these records in order for them to meet the double entry system of accounting, so as for you to be able to prepare the final accounts, that is the balance sheet and the income statement, so as to be able also to ascertain the profit that the business has made. So next we look at the approach or the procedure of completing records. So in case of single entry, whereby the transactions have only been posted once, that is in the cash records, or in case of destruction, loss of records, then the following procedure is applied to reconstruct uh, the records into the double entry system of accounting. So you have the following steps. The first step is to construct the statement of affairs, and the statement of affairs uh, is basically a list of assets and liabilities at the beginning of the accounting period. A list of assets and liabilities at the beginning of the accounting period. or which we can also equate to a balance sheet at the beginning of the period. The first step to reconstruct records from single entry into double entry system is to construct a statement of affairs, which is basically a list of assets and liabilities at the beginning of a particular period, yeah, which can also be equated to a balance sheet as at the first day of the accounting period. The next step, we construct a summary of receipts and payments. This is just like a cash book, yeah. So this involves the preparation of cash summary from the bank statement and other cash transactions. So you'll find that most traders under the single entry system of accounting will have such documents. We'll have a cash summary. Most of them will record cash inflows and cash outflows. So from these cash inflows and cash outflows in a bank statement, then you can prepare a summary of cash receipts and payments, which can also be equated to a cash flow statement, a cash book, whereby on the debit side you have cash inflows, on the credit side we have cash outflows. And then after preparing the cash, a summary of receipts and payments, number 3, we post the accounting entries. So here we see that information in step 1 above and step 2 above provides a basis for developing the accounts of the business. In step 1, we've seen it's the construction of the statement of affairs, which can be equated to a balance sheet at the beginning of the period. And step 2, we've seen it's about a summary of cash, receipts, and payments. So information in step 1 and 2, that is a statement of affairs and cash receipts and payments, is used in step 3, that is in posting accounting entries. So information in step 1, that is a statement of affairs, provides the opening balances of the accounts. So we shall do an example to illustrate that. So information in step 1 provides the opening balances of the accounts, whereas information in step 2 provides the information for posting into the accounts. So the information from the cash summary provides the transactions that took place during the year. So these transactions ought to be posted in the accounts. So therefore, we can, in summary, we say that information in step 2 shows the transactions, which provides the information for posting into the accounts. And then step number 4 is to adjust for any additional information that may be given, say for accruals, prepayments, depreciation, bad debts, etc. So these adjustments have to be taken into consideration. And then the final step is to prepare the final accounts. That is the balance sheet and the income statement. So you proceed further to prepare to do an example, an illustration on how to reconstruct financial statements from to reconstruct the records that are incomplete, either from rows of records or from a single entry system of accounting, to reconstruct into the double entry system of accounting in order for us to prepare the final accounts. So we have the following question. So we have KK, a sole trader, had the following assets and liabilities as on 1st April 2004 and 31st March 2015. So we have the following list of balances. So the assets and liabilities, and then those are the value of the items as on 1st of April. This should be April. The 1st of April 2014, those are the items, the value of the items. And on 31st March 2015, after 1 year, those were the values of the items. And then further, we are told that he did not maintain his accounting records on double entry system of accounting. He, however, kept a cash book with discount columns and a file of invoices received and issued. So the summary of his cash transactions was as below. So you can see down there, we have the summary, cash summary, the inflows on the debit side and the outflows on the credit side. And then the following information is available. That discount allowed during the year amounted to 12,300 shillings and discounts received to 13,600 shillings. Then we are told that during the year, KK took goods from the business costing 5,000 shillings for his personal use without paying for them. The other additional information is that motor car was subject to annual depreciation of 20% on book value. So the motor car was bought on 1st January 2015, and then we have the requirement that you prepare the KK's trial balance as on 31st March 2015. So we embark on that. So these records have been kept on the single entry system of accounting. They are incomplete. So we have the list of balances at the beginning and at the end, and we have the cash summary and the additional information. So we are required to reconstruct these these records into the double entry system in order for us to be able to prepare the trial balance as on 31st March 2015. So the steps are the step number 1. So begin with step 1. Step 1. Begin with step 1. Step 1, we prepare the statement of affairs. So the statement of affairs, we said this is a summary, this is a list of assets and liabilities as at the beginning of the accounting period. So at the beginning is, in our case here, it's the beginning of the accounting period is 1st of April 2014. So we prepare a statement of affairs as at 1st April 2014, a statement of affairs, which is basically a list of assets and liabilities as at when? As at 1st April 2014. So we do that. So we have KK's statement as on 1st April 2014. So you do that. So it's basically a trial balance zone. Balance sheet as on the first day of the period. So the list of assets and liabilities. So the statement of affairs. So on one side we have the assets. So just like a balance sheet, and then the other side we have capital and liabilities. So then you have the amount here. Put the columns well. So the assets, we have here. Okay, let me go through them quickly. I believe you understand that premises are assets. Premises are assets. The amount is 350,000 shillings. Then the other item we have is furniture. Furniture, which is 60,000 shillings. So these are the values as at 1st April 2014. Then we have inventory. Inventory, its amount is 62,800. Then we have accounts receivable, whose amount is 39,500 as at 1st April 2014. Then we have accounts payable. Accounts payable is a liability, so you have it on the capital and liability side. Accounts payable. Accounts payable, and its amount is 79,600. Then you have loan from industrial bank. It's a liability, so you have it on the liability side, and its amount is 120,000 shillings. Then we have the other item is wages and salaries due. Wages and salaries due are liabilities, so you also have them on the liability side. So wages and salaries due are current liabilities, so we have them on the liability side, and the amount is 9,200. Then we have prepaid rates. Prepaid rates, these are expenses that have been prepaid. So these are treated as current assets. So we have them on the current asset side of the statement and the statement of affairs. And the amount of prepaid rates is 2,500. Then we have rent received in advance. This is a prepaid expense. Sorry, this is a rent received in advance. Yeah, this is an income an income received in advance. Incomes received in advance are treated as current liabilities. Therefore, we have this on the liability side of the statement of affairs. The amount is 4,000. Then we have. So I hope we are in agreement. So income received in advance is a current liability, whereas prepaid expenses are current assets. Please revert to final accounts and end of year adjustments. Prepaid expenses are current assets. Incomes in advance are current liabilities. Accrued expenses are current liabilities. Yeah, so wages and salaries being accrued expenses should be treated as current liabilities. Other item we have is cash. Cash is an asset, so we have it on the asset side, and its amount is 43,800. And then we have capital. Capital is part of the liability, so we have it on the liability side, capital on the liability side, and its amount is 363,800. So we add the two sides. So how much do we get? So this should balance. This is just like a balance sheet. It should balance. So we see how much this should be equal to. 576,600 seems I've left out something because this is not balancing. Let me find out where the error is before we proceed. So the error is premises 350, furniture 60, motor car 18. I think there is motor car that has been left out. I left out motor car, so motor car should be there. It's an asset, so we have it in the asset side of the statement of affairs, and its value is 18,000. This add up to 576 here. So this is 576,000. So you should balance off. So I believe our statement of affairs as of now is okay. So the first step is to construct a statement of affairs, which is a list of assets and liabilities as on the first day of the accounting period. That is at the beginning of the period. And I said that the statement of affairs can be equated to a balance sheet at the beginning of the period. The next step is to construct the cash summary. Step 2. Step 2. We have the cash summary. And this you have been given in this question, the cash summary. So the cash summary is basically what you have in the question. Yeah, the way it is. So the cash summary, maybe I can copy paste it here. So this is a cash summary of this business. So I've just copied it and pasted it here. So this is a cash summary of this business. Yeah, a summary of receipts and payments. Yeah, so summary of receipts. So summary of receipts and payments, this is basically the same as the cash book. So what you are required here is to prepare the cash book. Simple as that. And then you move on to step 2, step 3, step 4, step 3, that is it. Step 3, that is posting transactions. Posting transactions, and to post transactions, in this case, we are posting them in the ledger. Posting transactions in the ledger is our third step. So in this case, we have been told that we use information from step 1 and step 2, whereby step 1 provides the opening balances and step 2 provides the information to post into the ledger. So therefore, we shall use the information that we have in step 1, that is from the statement of affairs, to to show the opening balances of the accounts. So you shall therefore prepare the opening balances from the statement of affairs. So you begin with the first account, that is premises. So you open an account for premises. So let me drag this down here. The first account is premises. So you open an account for premises. Premises account. Premises account, and show the opening balance of premises. So premises is an asset, and assets will always have a debit balance, so we shall therefore have balance on the debit side, the debit balance for premises, that is balance brought down for premises, and the amount is 350,000 shillings. The other account you have is furniture. So you open an account for furniture and you copy paste this. Furniture is also an asset, so it should have a debit balance. So therefore, on the debit side at the beginning, the amount of furniture is 60,000. Then the other account we have is from the statement of affairs, inventory. Inventory, that is stock. Stock is usually not part of double entry, so we shall leave that for now. So we shall not have an account for stock. So we skip inventory. Then we have accounts receivable. From the statement of affairs is the other account that you have. So you open an account for it. So accounts receivable. So accounts receivable. You draw an account for it. So you see that the statement of affairs provides the information for the opening balances. So accounts receivable is an asset, and being an asset, to have a debit balance. So on the debit side, balance brought down for accounts receivable. And the amount of accounts receivable is, from the statement of affairs, is 39,500. So 39,500 for accounts receivable. Accounts receivable is debtors, the same as debtors, that is. Then we have the other account, that is prepaid rates. So prepaid rates is an asset, it's a current asset, is a prepaid expense. Prepaid expenses should always be treated as current assets. So being a current asset, it will have a debit balance. So on the debit side, so therefore on the debit side at the beginning, we have prepaid rates. The balance brought down for prepaid rates is 2,500. Then the other account to open is cash account. So cash account is already captured in the cash summary. And as you can see, the balance brought forward for cash account is for 3,800. And the same case we have in the cash summary is for 3,800. So the cash summary has already been prepared for us. So you don't have now to prepare another cash account. It's already shown. It's already in step 2. So step 2 shows the cash summary, which is simply the same as the cash book or the summary of receipts and payments that shows the inflows and outflows of cash or the payments and receipts of cash. So in the cash book, we have on the debit side inflows, and on the credit side, we have the outflows of cash. And then the other account you have is motor car. Motor car is an asset, so you have the opening balance for the motor car. So you create an account for motor car. An account for motor car. Motor vehicles is an asset and therefore a debit balance at the beginning. So on the debit side, and the amount for motor car is 18,000 shillings. 18,000 shillings. So then we are through with the asset side of the statement of affairs. Then we move to the credit side of the capital and liability side of the statement of affairs. The other account we have is accounts payable. So you open an account for accounts payable. So accounts payable is the other name for creditors. Creditors are liabilities, and being liabilities, they have credit balances. So therefore, the opening balance for creditors should be on the credit side. So the balance brought down is at the credit balance for accounts payable, since these are liabilities. So therefore, the opening balance will be on the credit side, and the amount of accounts payable is 79,600. Then you prepare. Then the other account you have is loan from Industrial Bank, whose amount is 120,000 shillings. So you open an account for it. Loan from Industrial Bank. Loan from Industrial Bank. This is a liability, and being a liability, it will have a credit balance. So therefore, at the beginning, its balance will be on the credit side. So therefore, balance brought forward for loan from bank, the amount should be on the credit side, and the amount is 120,000 shillings. Then we have the other account is wages and salaries due. These are an accrued expense. Accrued expenses will always be treated as current liabilities. So therefore, we have them on the creditors on the liability side. So you open an account for them. Zinaitwaje? Wages and salaries due. So wages and salaries due. So being liabilities, you always have a credit balance. So balance carried down. The amount is wages and salaries due. The amount is 9,200. Then we have rent received in advance. This is an income received in advance. Incomes received in advance should always be treated as current liabilities. As such, they have a credit balance. So tumeona inaitwaje? Rent received in advance. Rent received in advance. Rent received in advance, I've said it's a current liability. As such, it will have a credit balance, and therefore, at the beginning, the balance will be on the credit side. So balance brought down for rent received in advance is equal to 4,800, sorry, 4,000. And then the other item we have is capital. The other item we have is capital, so you have its opening balance. Capital, you always have a credit balance. So at the beginning, its balance brought down shall be on the credit side. So balance brought down for capital is on the credit side, and the amount is equal to, capital is 363,800. So like that. So that is the opening balances, and the opening balances are extracted from the statement of affairs. That is from the step 1. So therefore we have these opening balances that we've gotten them from the statement of affairs in step 1. So then next we move to posting transactions in the ledger, and we obtain that information from step 2, from the summary of receipts and payments, or rather the cash book. So we begin with the first item. So okay, the first item here. So we skip the balance brought forward, so which is basically in the cash book, and we are not to do the cash book again because it's already here. So we move on to the next item, that is the accounts receivable. So in this case, the accounts receivable, also known as the debtors, this amount has been debited in the cash book. So this is to signify that the debtors paid the business, so which led them to debiting the cash book, and they were supposed to credit the debtors account. Yeah. So when debtors pay the amounts due to the business, the cash book is debited, and then the creditors are credited, because you know these creditors are decreasing and creditors are assets, and whenever an asset is decreasing, you're supposed to credit. So therefore the accounts receivable account ought to have been credited. So therefore we credit the accounts receivable account by cash, and the amount shall be 613,100. So you go to the accounts receivable account and credit. This is by cash, and the amount is 613,100. So like that, simply. Then move on to cash sales. So this is to show that there were sales made by cash. So when sales are made by cash, the double entry system should be debit cash account, credit sales account. In this case, the cash account has been debited by 213,600. So you ought to have credited sales account. So therefore, you need to have a sales account that is credited by 213,600. And you don't have a sales account as yet, so you open one. So sales account, which should be credited whenever a sale is made. So in this case, a sale was made via cash. So therefore, we credit the sales account by cash. Cash account credit via sales, and the amount is 216,300. So credit sales account, the amount is 216,300. And then we are told, yeah, so that is our sales account. That's how it should have been done. Then we move on to the other item. The other activity, that is rent, 62,000 shillings. So this is rent. In this case, money has been received. So this signifies that this rent is an income. Yeah? So cash has been received. So it shows on the debit side that cash increased by 6,200 shillings. So the other credit side account to be credited in this case is rent. That is rent income. So this therefore should be rent income. So these are double entry. A double entry must have a debit entry and a corresponding credit entry. So this is a debit, so the corresponding credit should be in the rent income account to signify that income was received for rent. That is 62,000 shillings. So therefore, we don't have a rent income account as yet, so we open one and credit this amount that was debited in the cash account. So therefore, open rent income account. rent income account, and this account should be credited. Because cash was debited, so therefore rent income is credited with the receipt of rent. So by cash account, and the amount is rent income 62,000, like that. We move on to the next transaction, that is capital, and capital increased. So this okay, yeah, capital increased. Okay, what you are seeing here is that money increased, cash increased with capital. So that is to say that the KK brought in extra capital of 50,000 shillings. So cash was debited, and then capital on the other side is credited. You understand that capital, whenever capital increases, you're supposed to credit. So therefore, capital account should be credited with 50,000 shillings. And you have capital account already, capital account here. So therefore, you credit capital account, that is by cash, and the amount that you are increasing or crediting capital with is 50,000 shillings. 50,000 shillings. So to show that capital of the business has increased. Then we move on to the other item, the other transaction. So you are through with the debit side of the cash book. So you move on to the credit side of the cash book. So you have accounts payable, 502,600. So in this case, cash went out. So you are seeing cash being credited. So cash decreased. So therefore it credited cash. So we ought to have a debit. This debit should be on the accounts payable. Yeah. So this is to mean that accounts payable are paid off. Accounts payable are liabilities. So liabilities, whenever the liabilities decrease, we're supposed to debit. So in this case, the accounts payable were decreasing. So therefore, you're supposed to credit the accounts payable. So therefore, you go to the accounts payable and credit by cash that amount. So the accounts payable, so you have them here. So you debit them, sorry, because they are decreasing. Whenever a liability is decreasing, you're supposed to credit. So the accounts payable in this case is decreasing. So it means that they are paying us. So therefore, we credit them by, and the amount is 502,600. Accounts payable, where are they? So debit this 502,600. We proceed. The other item we have is cash purchases. So in this case, cash has been credited. So the debit here should be on the purchases account. So it means that they purchased goods worth 81,400. So whenever purchases by cash is made, we're supposed to debit purchases, credit cash. So cash has been credited, we therefore need to debit purchases. And we don't have a purchases account as yet, so we open one. So we open purchases account. So we open purchases account. And debit purchases. This is by cash, and the amount is purchases by cash, and the amount is 81,400 shillings. 81,400 shillings. Then we proceed back to our cash summary. The other item we have is wages and salaries. In this case, cash has been credited. So we ought to have debited another account, that is here in this case, wages and salaries. So this is to signify that wages and salaries were paid of 83,200. And whenever wages are paid, it means that these wages are increasing. And wages are expenses. And whenever an expense is increasing, you're supposed to debit. So therefore, wages and salaries ought to have been debited. So therefore, we create a wages and salaries account. Wages and salaries account, or rather wages and salaries expense. So wages and salaries expense, which ought to be debited. So we debit this by cash. The amount is wages and salaries. The amount is 83,200. Like that. Move on to our cash summary. The other item we have is rates and insurance. So cash has been credited here. So it means on the corresponding debit should be made on the rates and insurance with the increase in rates and insurance. These are expenses that are increasing. Expenses, whenever they increase, they're supposed to be debited. So therefore, debit rates and insurance expense account. So you open rates and insurance expense. Rates and insurance. So this is an expense that is increasing. Paying cash, the amount is equal to, so from the summary of receipts and payments, rates and insurance is 16,400. We proceed further to transport. In the cash summary, cash transport was paid, cash decreased, so it was credited. So you ought to have debited transport expense account with the increase in transport. So therefore, we don't have transport expense account, so you open one. So you open transport expense account. Transport expense and debit. So this is by cash, and the amount is transport expense by cash. The amount is 28,200. The amount is 28,200. Let me autofill that amount. Transport 28,200. Like that. Then back to our cash summary. The other item we have is bank charges. Bank charges, in this case, they have been credited in the cash book, so you ought to have a debit, and in this case, the bank charges account. So therefore, we open the bank charges account. The bank charges account. Bank charges account and debit. Since cash has been credited on the other side, bank charges is an expense. So expenses, whenever they increase, you're supposed to debit. In this case, they are being paid, they're increasing, so we debit. So bank charges, the amount is from the summary of receipts and payments is 15,800. So like that. Then we have the other item is general expenses, 72,700. So we don't have an account for them, so we open one. So the general expenses account. The general expenses in this case, they're also increasing. They have been paid off. So as you can see in our cash book, the cash has decreased. So it means therefore the general expenses will increase. The cash has decreased. So it has been credited. The cash has been credited here by general expenses. So general expenses therefore will be debited. So each debit will go with a credit. And being an expense that is increasing, so therefore we debit general expenses account. So we debit general expenses account by cash. By cash, the amount is equal to. So general expenses 72,700, like that. Then we move on to the other item. Is loan interest. Loan interest of 6,000 shillings. So cash has been credited, so therefore it means we debit loan interest account. So you open loan interest account, since Atuna. You open loan interest account. and debit by cash, and the amount is from the cash book, the amount is 6,000 shillings. So like that. Then back to our cash summary. A loan repayment of 100,000 shillings. So cash has been credited, so therefore we need to debit the loan account. So we have loan, in this case the loan from Industrial Bank. So therefore we debit the loan from Industrial Bank, because we debit the loan from Industrial Bank because the loan has decreased. A loan being a liability, whenever liability is going down, we're supposed to debit. So the loan repayment means that the loan is declining, is decreasing, so we therefore debit the loan account. Cash has decreased. Cash is an asset, and whenever cash being an asset decreases, we're supposed to credit the asset account. So therefore, loan repayment has decreased the cash of the business, so therefore it has been credited, and then on the other side we debit the loan from Industrial Bank because the loan has declined. So therefore, we have the loan from Industrial Bank here. So we credit it. This is by cash, and the amount is 100,000 shillings. 100,000 shillings. Then we proceed to the other item, new motor car. So cash has decreased, has been credited, meaning that it is decreasing. So therefore, we need to debit, and in this case, we debit the motor car that has been purchased. So motor car has come in, it has increased, so therefore debit the motor car account with the increase. Being an asset that is increasing, we therefore debit the motor car. And we have the motor car account, we have it here. So being that the motor car has increased, we debit. We have credited in the cash account, so therefore we debit in the motor car account. So there, in the motor car account, we debit, and the amount is 30,000 shillings. Then the last item in the cash summary is drawings. So drawings, in this case, cash has gone down, so it has been credited. And we say that drawings is a deduction in capital. So whenever drawings are made, we're supposed to debit the drawings account. So therefore, we open the drawings account and debit. So cash has been credited by drawings. So there ought to be a corresponding debit entry. So in this case, it goes to the drawings account. So therefore, debit drawings by cash. Debit drawings by cash, and the amount is debit drawings by cash, and the amount is 36,000 shillings. So drawings, the amount is 36,000 shillings. So that is it. So that is posting transactions in the ledger. Step 3. So the next step, you are supposed to do the adjustments. And then we balance off the accounts so as for us to prepare the trial balance. So we do the adjustments. So the following adjustments from the additional information in the question. So I hope you are together. So step 1, we did the statement of affairs. Step 2, we did the summary of receipts and payments. And step 3, we have posted the transactions in the ledger, as you can see in those ledger accounts. So next we adjust. So have the first adjustment as highlighted there, that discount allowed during the year amounted to 12,300 shillings, and discount received amounted to 13,600. So what happens with discounts? So a discount is an expense, yeah. So a discount allowed is given to the customers of the business. So we begin with the discount, that discount allowed. So discount allowed during the year of 12,300. So discount allowed is usually given to the customers of the business, yeah, and it's an expense to the business. So you give them discount. So it means that when you give the customers a discount, is that they will end up owing you less. So come maybe for example you owe me 200 shillings. Sorry. Say for example I owe you 2,000 shillings. I am your customer. or rather your debtor. So I owe you 200 shillings, and then you give me a discount of 100 shillings. It means that I will therefore owe you 100 shillings. That is the 200 shillings that I had owed you minus the discount you gave me of 100 shillings. So in the end, I will end up owing you 100 shillings. So therefore, my account has been reduced by the 100 shillings of the discount. So the discount allowed will reduce the customer's account or the debtor's account. And in our case here, the discount allowed will reduce the accounts receivable account. So accounts receivable is an asset. And whenever the asset is decreasing, we're supposed to credit. So therefore, we credit the accounts receivable account with the discount allowed. Credit the accounts receivable with the discount allowed account, and the amount being 12,300. And then this amount needs to be debited, and it will be debited in the discount allowed account. And the discount allowed account is an expense. This discount allowed is an expense. So you're incurring, yeah? We are losing money to our customers. So you give me a discount of 100 shillings. So that is a loss to you. So being a loss, we treat it as an expense. So expenses, whenever they increase, you're supposed to debit. So therefore, we debit the discount allowed account. So open the discount allowed since Atuna. We open the discount allowed account and debit. So debit the discount allowed account. This is by accounts receivable. Mazinaitwaje? By accounts receivable. So we debit the discount allowed by accounts receivable. The amount is 12,300. 12,300. So debit the discount allowed by 12,300. So that is for discount allowed. So next, still on the same adjustment, you have discounts received of 13,600. So the discounts received are those which the business has received from its creditors, from its suppliers. So we receive a discount from the supplier or the creditor. Yeah. So this will therefore affect the accounts payable. The accounts payable. So discount received is the opposite of discount allowed. Discount received is a revenue to the business. It's a gain. So a discount received is given by the customer, by the creditors. So say for instance, I am your creditor. You owe me 200 shillings. So I've given you a discount of 100 shillings. So you have received the discount. So to you it's a gain or a revenue. So me having given you the discount of 100, it means you therefore will end up owing me less. So if you initially owed me 200 shillings and I gave you a discount of 100, it means the amount that you owe me has decreased. So therefore this will decrease the accounts payable. So the accounts payable will decrease. Accounts payable are liabilities, and whenever a liability is decreasing, we're supposed to debit. As such, we debit the accounts payable account with the discount received. Therefore, we debit the accounts payable with the discount received. Like I've done it there. So, and the amount for discount received is, from the question, from the additional information, is 13,600. So we debit the discount, the accounts receivable by the discount received, and the amount is with the amount being 13,600. 13,600. Debit the discount received. Then on the other side, a discount received is a revenue or a gain to the business. So whenever a revenue is earned, we're supposed to credit the revenue account. So therefore, this debit in the accounts payable of discount received should be credited in the discount received account. discount received being a revenue. So therefore, we open a discount received account and credit. Do that. Open discount received account and credit being a revenue. So this is by accounts payable. The amount is 13,600. 13,600. So credit the discount received by 13,600. Then move on to the other additional information. The other additional information that is that as highlighted that during the year KK took goods from the business costing 5,000 shillings for his personal use without paying for them. So these are drawings have been taken from the goods. So whenever drawings are made, you're supposed to credit to debit drawings account and credit, in this case, purchases account, because in this case it's goods that have been withdrawn. So whenever goods are withdrawn, we credit the purchases account and then debit the drawings account. So therefore, credit purchases account and debit the drawings account with this. So therefore, we have our purchases account, trying to locate them. Purchases account here they are. So we credit them. We credit purchases by drawings, and the amount we credit is, so drawings of 5,000 shillings. We credit our purchases account by drawings of 5,000 shillings. So like that. Then we debit the drawings account. Drawings account we debit. And where is our drawings? We have our drawings here. So debit the drawings account by purchases, the amount being 5,000 shillings. Whatever is here, the amount being 5,000 shillings. Then we proceed to the last additional information, that motor vehicles are subject to an annual depreciation of 20% on the book value. So the motor car was bought on 1st January 2015. So in this case, we have a depreciation. So depreciation on motor vehicles, so we work on this. So let me show a working here. So workings. So I hope you can see that. The working here is a depreciation on motor vehicle. Depreciation on motor vehicle. So in this case, we have been told there is a motor vehicle that was purchased during the year. So as you can see, there's a motor vehicle, as you can see in the cash summary, as highlighted there. A motor vehicle of 30,000 shillings came during the year, and we debited this in the motor car to signify that motor vehicle came in. And at the beginning of the year, the motor vehicle, the book value of the motor vehicle was, we had another motor vehicle that was there of 1,800 shillings. So it's like we have the new motor vehicle and other motor vehicles that were there of 1,800 shillings. So therefore their depreciation, let me pull this for ease of reference, let me pull them here. So therefore we depreciate these two motor vehicles separately, because the motor vehicle of 30,000 shillings, the new one, the additional one, was acquired in January 2015. So we cannot charge a year's depreciation on this. So you only charge a portion of the year, a fraction of that year. So therefore, we charge 20% on the 18,000. That is for the old motor vehicles, and a fraction of the year for the depreciation of the additional motor vehicle at 20% of the book value. So therefore here we have that is 20% on the motor vehicle at the beginning. That is 18,000, which is equal to 18,000, which is equal in this case to 0.2 times 18,000. That is 3,600. That is the depreciation on the old motor vehicles. And then you have the depreciation on the new motor vehicle. So that is on the new motor vehicle is 30,000 shillings. But the motor vehicle was obtained in January, 2015, and we are currently in March 2015. So the motor vehicle has only been there for 5 months, for 3 months. It has only been there for 3 months, so we cannot charge a year's depreciation for that motor vehicle. So therefore, 20% on 30,000 shillings on a fraction of the year. That is what 3 months of the year. Yeah, hope unanielewa. So a fraction 3 months of the year, that is 3/12. So as such, the depreciation on the new motor vehicle shall therefore be 0.2 times 30,000 times 3 divided by 12, which is 1,500. So therefore, in total, the depreciation shall be equal to, is the total depreciation, total depreciation shall therefore be equal to 3,600 plus 1,500. That will give us 5,100. So this depreciation has to be taken into consideration. The depreciation that you have determined of 5,100 has to be taken into consideration. So depreciation is an expense. So, and being an expense, it should being an expense, it should be deducted. It should be shown as an expense in it should be or rather depreciation. So it should be an expense. So therefore, in the trial balance, this 5,100 should be shown as an expense. And then the book value of the asset needs to go down. Yeah. So the book value of the asset will go down by 5,100. So therefore, we will credit the motor car. So there are various approaches. So we can credit the motor car with a depreciation of 5,100 and then open so in this case, let us credit the motor vehicle with the total depreciation. So in this case, because the motor vehicle's value will decline by 5,100, so therefore debit the motor car account. So through depreciation, and the amount is 5,100. And being that the depreciation is an expense and this expense is increasing, therefore we shall have a depreciation expense account which we shall credit. So which we shall debit because it's an expense. So therefore, open depreciation on motor car account. And then credit. So we've credited the motor vehicle account. So therefore it means now we debit the depreciation on motor vehicle account. So we've credited the motor vehicle. So therefore now we debit the depreciation on motor vehicle account. Debit depreciation motor, is by motor vehicle. On motor car, the amount you've seen is 5,100. So here's a motor car. 5100. So debit the motor car account without depreciation. So debit the depreciation on motor car account. So I have there we are together. So I believe I have exhausted all the additional information. So next is to balance off these accounts. So to balance off these accounts, and as I balance off these accounts, I have to take into consideration back into our equation, we have these balances at the end of the year. So let me highlight them. So these balances at the end of the year. So these balances are the ones that should be in these accounts at the end of the year. So for instance, for premises, the balance brought down is 350,000 shillings. So as seen, so balance carried down. So the closing balance of an asset, it's a debit balance, and that should be seen on the credit side of the account. So therefore, we have given that it's 350,000 shillings, which is balancing well. So this is balancing. So that one has no problem. Then we have the other item, that is furniture, whose balance is 5,300. Furniture whose balance is 5,300. So furniture being a balance, being an asset, it will have a debit balance. And whenever closing the period, the debit balance should be on the credit side. So balance carried down for furniture is 5,300 from the equation. It's 5,300. So as you can see, for furniture the balance is 5,300. So the total of both sides cannot be 53. So you take the higher total of 60,000 on both sides as the total of both sides. So this to show or to say that on the furniture declined in value from 60,000 to the end of the period 53,000. So they have declined in value. So and they've declined by 50 minus 63, 60,000 minus 53, which is equal to 60,000 minus 53,000. That is 7,000 shillings. So this will assume that has gone, this decline has been via depreciation on furniture, because you're not told of any sale of furniture. So this can only be by depreciation. So therefore, I can indicate here that is depreciation on furniture. So I hope you get me, you understand. So in case there is any area that you don't understand, please feel free to ask questions on WhatsApp and I shall answer you. So there is a decline on furniture. So let me indicate that this is by so for your understanding, this by let me call this the balancing figure. For your future reference. So this is the balancing figure, yeah. So we've obtained this 7,000 by balancing off this account. So this difference in furniture, which signifies a deduction in the value of furniture, has been brought about. We assume that it has been brought about by depreciation, which has led to the decline on the value of this furniture. So it has declined by 7,000 shillings, which can only now be by depreciation because you have not been given any other information. So yeah, so this depreciation on furniture needs to be it's on the credit side in the furniture, so there has to be a debit. So the debit has to should therefore be in the depreciation on furniture account, which should be debited being an expense. So therefore we have here, you can create account for depreciation on furniture account. Depreciation on furniture account. So being an expense, depreciation is usually an expense, so we usually debit it whenever it is incurred. So this is so therefore we debit depreciation on furniture account. Debit depreciation on furniture account, and the amount is, as you've seen it from the furniture account, it's supposed to be 7,000. 7,000 shillings is the amount of depreciation on furniture for that particular year. So you proceed, we are in the balancing step or a balancing of account step in this question. So you have done away with furniture. The other item is motor car. Motor car you haven't been given its final balance brought carried forward. So okay, we shall balance it off at the end. Then we have inventory. Inventory, no accounts for inventory, so we shall just basically keep that in mind. So no account for inventory. The other account we have is accounts receivable, whose balance brought down or carried down at the end is 4,700. So you have our accounts receivable. So accounts receivable being assets, they always have a debit balance, and on closing the credit balance will appear on the debit side of the account. So therefore, we shall have in the accounts receivable the balance carried down, and you've seen the amount is how much. I revert to the question, the amount for accounts receivable is 4,700. So therefore, the totals of the both sides of this account is equal to sum. So the total needs to be equal. So it's 66,100. 66,100. So we have the balancing figure. So we can see that the debit side of accounts receivable is less. The debit side of accounts receivable is less than the credit side. And the difference is by 66,100 minus 39,500, which is 66,200. So accounts receivable they have what can I say? Have they increased? Yeah, they increased by 6,626,600. So an accounts receivable, an asset, whenever it increases, it's always debited. So this debit in the accounts receivable signifies an increase in the accounts receivable. So in what ways can accounts receivable increase? Accounts receivable can only increase through sales. That is credit. In most cases, it's through credit sales. So therefore, this 626,600 is through credit sales. So let me indicate this is the balancing figure for the sake of your revision. So that you don't wonder where this amount came from. So the credit sales is the balancing figure. So don't wonder where 626,600 came from. This 626,600 came from balancing of this accounts receivable account. So in this case, accounts receivable have increased during the year. That is by 626,600, which is by credit sales. So it has been debited in the accounts receivable account. Then therefore it needs to be credited. And where is it credited? It is credited in the sales account. So sales, whenever they increase, they're supposed to be credited. So this is to show that we sold to these accounts receivable on credit during the year. So they have been debited in the accounts receivable account. They ought to be credited in the sales account. So therefore, we go to our sales account and credit. So we have our sales. Where are the sales? Sales here. So we credit the sales account, and that is by accounts receivable. The amount is 626,600. This is the amount of the sales that we made on credit during the year. That KK made on credit during the year. Then we proceed to the other balance, accounts payable. The balance of accounts payable is 9,300. Accounts payable is a liability, and liabilities always have a credit balance. So the credit balance, so accounts payable, where are the accounts payable? The accounts payable will always have a credit balance, and a credit balance will always be on the debit side when closing. So balance carried down. Accounts payable, and the amount is 9,300. And the amount is 9,300. So this is a credit balance on the accounts payable. So a credit balance at the end of the period should always appear on the debit side of the account. So the totals of the two sides of the account should therefore be the heavier total. So in this case, for the accounts payable, it should be 609,200 on both sides. So it shows that the credit side of the accounts payable is, in this case, is less. So inside the difference here, so that is 609,200 minus 79,600 to show that the accounts payable increased. Accounts payable, whenever they increase, they are supposed to be credited. So this credit entry here is an increase in the accounts payable. This is a liability. Increases are shown by crediting. So therefore, this is an increase. And accounts payable can only increase via credit purchases. Accounts payable are creditors of the business. So they are, in most cases, they increase through us purchasing on credit basis. So therefore, if bought from them on credit, therefore we credit their account with the increase. So therefore, this 529,600 signifies an increase in the accounts payable account. And this, maybe let me also indicate that this is a balancing figure, so that in your revision you don't wonder where this figure came from. So this was obtained by balancing of these accounts. So credit purchases increase the accounts payable of the business. So these have been credited in the accounts payable account, meaning that we purchased from them on credit basis, which increased the amount that we owe them by 59,600. So this has been credited in the accounts payable account. Therefore, it needs to be debited in the purchases account, showing that we had increases in purchases by 529,600. So therefore, we debit the purchases account by 529,600. So we have purchases account here and debit by accounts payable. The amount is, as we have seen from accounts payable, the amount is 529,600 as shown there. Then we move on to the next item. The other item to balance off is loan from industrial bank, which has a question mark. So let us first insert these balances and then we balance off the other items. Or maybe let me just balance it off. Loan from industrial balance, the balance as given there is a question mark, so you can balance it off. So loan from industrial bank, so the balance brought forward is 120. So the total of the two sides is equal to, say, 120. We take the heavier total for both sides. $20,000 for both sides. So here we have the difference equal to 120 minus 100, 20,000 shillings, which should now be our balance carried down. So it means that we still owe the industrial bank 20,000 shillings. We began with a balance of 120, and then we paid them 100,000 shillings. Then we are still left with 20,000 shillings that is owed to the industrial bank. These are credit balance. Yeah, this is the balance brought down is an opening credit balance, which should be on the credit side of the account. And the balance credit carried down from the loan from industrial bank, as you can see here, is still a credit balance, which should be seen on the debit side. So this is a credit balance on the loan from industrial bank. Then we proceed to the other account. Wages and salaries due are 7,500. So you have an account for wages and salaries due. So being a liability, wages and salaries due will always have a credit balance. So therefore, on the credit side, we have the balance carried down for wages and salaries due, and the amount is, as in the question, is 7,500. 7,500, and the total of both sides, we take the heavier one, is 9,200. 9,200. So this is the total of both sides. It needs to be equal. So our credit side is less, and there is less by how much? By 9,200 minus 7,500, 1,700. So this is wages and salaries due is a liability, and a liability, whenever you see a debit entry in a liabilities account, it means that there is a decline. So this means that the wages and salaries were paid during the year. Yeah. This means that wages and salaries were paid during the year. So maybe I can indicate here that is wages and salaries paid, and this should be the balancing figure. Wages and salaries. Wages and salaries. 1,700 should be is a balancing figure for wages and salaries. So it means that the wages and salaries of due of 1,700 were paid, and these were paid in the cash book, whereby you can see where wages and salaries of 83,200 were paid. But we put this amount in the wages and salaries account. But this 1,700 here ought not to have gone to the wages and salaries account. It ought to have gone to the wages and salaries account. So therefore, this debit here in the wages and salaries paid, in the wages and salaries due account, we need to credit it from the wages and salaries expense, because that amount was not to go to the wages and salaries expense account. It was supposed to go to the wages and salaries due account. So this debit here in the wages and salaries due should be credited from the wages and salaries expense account. So therefore, you go to the wages and salaries expense and credit here. Yeah, so this is by wages and salaries, and the amount is 1,700. 1,700, like that. So any questions, I'm always free. We proceed. The other balance you have is prepaid rates. Prepaid rates of 3,600. So the balance of prepaid rates at the end is 3,600. Prepaid rates is an asset, and assets will always have a debit balance. So therefore, prepaid rates, we have the balance carried down, should be on the debit side, and the amount is 3,600. 3,600 for prepaid rates. So the total of both sides should be, now we take the heavier total. So it's 3,600. So the debit side of the prepaid rate is less. So this is by the amount, the The difference between the two sides is 3600 minus 2500, which is 1100, which is a balancing figure. So in this case, prepaid rates, prepaid rates are assets. Yeah? We say that prepaid rates is a current asset. This is a prepaid expense, and prepaid expenses should be treated as current assets. So current assets, whenever they increase, is supposed to debit. So this debit here signifies an increase in the prepaid rates account. So it means that there was another prepayment of rates during the year. So it was went to the prepaid rates expense account. So let me indicate that. And this is the balancing figure. So it means here that the prepaid rates have increased, yeah, by 1100. So you have still prepaid by 1100 during the current year, but this we posted it in the prepaid in the rates and insurance, as you can see now here. We posted it, we took it to the rates and insurance account, which was wrong. It was supposed to go to the prepaid rates account. So therefore, to correct for this, we go to the rates and insurance account and credit the prepayment. So credit this 1100 from we credit the 1100 from the from the rates and insurance, and debit it in the prepaid rate as we have done here. So you go to rates and insurance and credit the prepaid rates. So rates and insurance, where are they? Here we credit the prepaid. Credit the prepaid rates, and the amount is 1100. Where are they? 1100, like that. Then we move on to the other item. The other balance is for rent received in advance. Rent received in advance, this is an income in advance, and incomes in advance should be treated as current liabilities. And current liabilities always have a credit balance, so this 6800 should be a credit balance in the rent received in advance. So you have rent received in advance. Where is it? Here. So being a credit balance, so the balance should be on the credit side. Balance carried down. So on the credit side, so the balance is equal to 6,800. So therefore, the total should always be the equal. Take the heaviest total on both sides. So in our case, this rent received in advance should be, the total should be 6,800. So you have a deficiency on this side, on the credit side. So this the deficiency is 6,800 minus 4,000, which gives us 2,800. So rent received in advance, we have said it's a current liability. This is an income in advance. Incomes in advance are current liabilities. So a credit in a liability signifies an increase. So as such, this 2,800 is an increase in the rent received in advance account. So it means that our tenants have prepaid us still in this year, and they increased this prepayment by 2,800. So therefore, this should go to rent in yeah, this has been this amount went to the rent income account. Yeah, this amount went to the rent income account. What am I trying to say? Okay, rent received in advance has increased by 2,800. So as you can see in our cash book, we don't have any rent received in advance. So this amount must have gone, rent received in advance is 6,200. But part of it should have gone, part of it is prepaid. The part of it, the 2,800 is prepaid. It ought not to have gone to the rent, to the, it ought not to have gone to the rent income account as I did it here. It shouldn't have gone to the rent income account. It should have gone to the rent received in advance account. Sawa sawa. So therefore we debit the rent and insurance. Rent income account, where is it? We credit the rent income account to remove the prepayment from the rent. I'm tired also. So we credit the rent income account with the prepayment. So to remove the prepayment from the expense. So remove the prepayment from the expense, that is the rent received in advance. So this amount, this 2,800, let me deduct it first. This 2,800 that was captured when cash was being received, it ought not to have come to the rent income account. It ought to have gone to the rent received in advance account. So therefore, to correct for this, we deduct this from the rent income account, and to deduct the revenue means we debit that revenue, so which has been done there. So we credit the rent, we debit the rent income account with the rent received in advance, and then debit the rent, and then credit the rent received in advance account here, as you can see here. And this is by the, okay, for your revision purposes, this is a balancing figure. So the rent income in advance has increased from 4,000 to 6,800, and is by paying an advance of another 2,800 shillings, which in our case went to the rent income account, which was wrong. So to correct for that, we debit the rent income and credit the rent received in advance account. So yeah, so that is it. So I hope you are not tired. I'm also tired, so please bear with me. Any questions can be channeled to my WhatsApp. Then the other balance we have is cash account of 24,500. This is already catered for in the cash summary here. So you have the 24,500 here. So that is already done for us. And the balance brought forward for cash is already there. So that for cash is okay. The other item we have is capital. Capital is this, that is three, the balance brought carried down for capital is, we have a question mark. So you need to do that manually. And where is capital? Capital is here. So the balance of capital. So capital, the balance, the total of the credit side is 413,800. Should be equal here. So I know you know how to balance of accounts. So capital, basically this has increased. The balance of capital, balance carried down is 413,800. So it increased from 363 to 413,800 via money that was brought in as shown in the cash summary. So it means that KK brought in capital of 50,000 shillings. So that is it from the balances shown in the question. So unless the other accounts that have not been balanced off, so I can balance them off here. So we have like motor car, should be maybe balance of motor car. So motor car balance carried down for motor car is equal to 4,800. minus 5100. So the balance carried down of motor car is 4900. Any other account not balanced off? We have sales, we balance them off. The balance carried down from sales is 840, 200. Then you have rent income account. The rent income account, the total is 6200 on both sides. The balance here is the balance carried down. Then we have for purchases. So I hope this is a process that is not new to you. And then you have balance carried down for purchases is equal to 611 minus 5,000, 606,000. Then wages and salaries due. Total of both sides, we take the heavier total equal on both sides. And the balance of wages and salaries expense, that is balance carried down, should be equal to 83,200 minus 17,700. So like that. Did I ever finish this? Rates and insurance, balance this thing off. Sorry. So balance $16,400 minus 1,100, so 5,300. Transport expense, achana na hivyo. Though it should be balanced off, It's only that I'm also a bit tired. So the drawings account, the total is 4,100 for both sides. So the drawings, the total drawings for the year is the balance carried down for drawings is like we have it there. So those are the accounts. So next the question requires us to do the trial balance. So you do the trial balance of KK. So I can do it here. So KK is as on 31st March 2015. Here you have the particulars. You have the debits, you have the credits. So we begin with the first account that you have is okay, for the sake of not forgetting, let me begin with one account, one item that is not here as yet. So you begin with the opening balance of inventory. inventory. Opening inventory has to be there. Which the opening inventory is 628,800, 6,800. And then we have the other accounts. We have cash. So stock is an asset, and assets always have a debit balance. So therefore, we have opening inventory on the debit side of the shower balance. Then we have cash. Its balance brought forward is 2,004. It's 24,500. Then after cash, the other account we have is premises. So you have premises. Whose balance carried down is premises is an asset. Assets always have a debit balance, and what you have here in the premises account is a debit balance of 350,000 shillings. Then the other account we have after premises is furniture. Whose balance carried down should also be a debit balance because it's an asset. That is 5,300. Then the other item we have is after furniture. The other item we have is accounts receivable. Accounts receivable, which is accounts receivable, which is also another debit balance. Being an asset, should be a debit balance of 4,700. After accounts receivable, we have prepaid rates. Prepaid rates, this is a prepaid expense. Prepaid expenses will always be current, will be an asset, and being an asset, it will be a debit balance. So prepaid rates, the balance carried down is 3,600. So like we have it there. After prepaid rates, we have the motor car. So you have motor car here. So when you pull this down, motor car, and the value of motor car, the balance carried down for motor car is 49,200. And being an asset, it will always be a debit balance. And as you can see, this is a debit balance. Then we have accounts payable. Accounts payable, these are liability. Liabilities always have a credit balance. So this 93,000 is a credit balance. Then we have loan from industrial bank. Loan from industrial bank, this is a liability. And being a liability, it's a credit balance. So 20,000 is a credit balance, as you can see. Then we have, pull this down. Wages and salaries due is a liability, and being a liability should be a credit balance, as you can, and this 7,500 is a credit balance. So on the credit side, 7,500. Then we have rent received in advance, which is a current liability, and being a current liability, it should be a credit balance. So 6,800 is on the credit side. Then we have capital. Capital always have a credit balance. So 14,800 is a credit balance. So we have it here. Drag this down. The item we have is sales. Sales is a revenue. Revenue is we always have a credit balance. So 626 600 so sales is 840 200. These are credit balance, not 626. 840 200. Then rent income is a revenue. Rent income is a revenue. Revenues we always have a credit balance, so 59 200. Then we have purchases. Purchases is an expense. Expenses will always have a debit balance, so 606,000. 606,000 is a debit balance on the debit side. Then we have wages and salaries expense. Wages and salaries expense. This is an expense. Expenses will always have a debit balance, so it's 15 is a debit. Then we pull this down. Wages and salaries. So next we have rates and insurance. Rates and insurance, which is an expense. Expenses will always have a debit balance, so 15,300 for rates and insurance is okay. Then you have transport expense, which should be a debit balance, so 28,200 being an expense. Then you have bank charges, which should also be a debit balance being an expense, so 1,500. Then you have general expenses, which is an expense, should be a debit balance. Then you have loan interest, which is also an expense, therefore should be a debit balance. Then we have drawings, a deduction in capital. Drawings should always be a debit balance. Drawings should always be a debit balance, being a deduction in capital. Then we have discount allowed, an expense, should be a debit balance. Discount received is a revenue, therefore credit balance. Then depreciation on motor car is an expense, so a debit balance. Depreciation on motor car is an expense, so it should be a debit balance. Then lastly, depreciation on furniture, which is an expense, which should also be a debit balance. That is it. Let's see whether this thing is balancing off. 1454 100. Oh my goodness, it's balancing off. Yeah, so the total of both sides, what, therefore 1454 100. So it has balanced off by God's will. Anyway, so that is how it should be. So thank you for your attention. So I know there are many areas that I may have left you hanging. So in case of any questions, kindly, I'm free. So kindly you can send the questions to my WhatsApp or maybe give me a call or maybe schedule a time so that we can meet and discuss these things out. Thank you very much.